Stocks pushing higher amid optimism that the Fed is getting a better handle on inflation. The move to the upside today, adding to last week's gains as investors prepare for a very busy week of earnings. Let's break it all down and what we can expect. For that, we want to bring in Linda Dissel, Federated Hermes Senior Equity Strategist. Linda, it's great to see you. So earnings is certainly going to be the next big test here for the markets. We've heard from some of the big banks. Bank of America was out with a note this morning saying that of those that reported, a small number, but 77% have beat so far. Is that going to be similar here as we look out to the rest of earnings season?
Well, good afternoon. Thanks for having me today. And, earnings season is probably one of the better catalysts for where the next moves in the market will be. And it's really a question mark. You can extrapolate from early times. And as you suggested, we're early into this season. We'll be hearing from more banks this week. We'll be hearing from some other big names out there, but really we have to wait till we get into the meat of it. And what we want to hear is companies' outlooks going forward, which has been mixed. Small business optimism has been, well below the long-term averages. They still worry about an inflationary situation, but their inflation levels are definitely coming off the boil here. So we'll be looking for that. Right now, it looks like we'll see a mild decline, much as what we saw in the first quarter. And what we're really interested in at Federated Hermes is the back half of this year, where we think you might really see concerns in terms of earnings.
What concerns specifically?
Well, because what's been happening here is you've been seeing throughout the economy a disinflationary environment, which is good. It's good for consumers, but you've not seen it in wages. In fact, the Atlanta Fed wage tracker, which looks at skill by skill set, kind of apples to apples, shows us that you're still getting 5% year over year wage hikes. Well, if a company's expenses are still going up, to the tune of 5% or so, but their inflation overall and the inflation that we see comes down, that can hurt their top line, while margins can get hurt, and that can start to really bite into their earnings on a going forward basis. It's really more about disinflation not yet hitting the most core of inflationary problems, which is the wage situation. Of course, that's what the Fed's watching as well, as they're expected to raise again here in July.
Yeah, certainly. We'll talk a little bit more about that in just a second. But getting back to earnings and some of the themes that we are going to see this earnings season, investors are also closely watching for any commentary around the consumer. We did get some of that from the big banks last week. But are you expecting to see a further deterioration just in terms of spending power and what consumers are able and willing to spend on?
Well, the consumer, we're a consumer-led economy. That's an all-important question. And to the extent our unemployment situation is strong, it remains very, very strong. And even consumer sentiment looks pretty good, especially for their current situation. Anybody who goes to an airport knows that there's no recession at the moment. There's a lot of demand out there. And if I have money in my pocket, if I have a job and I've not lost it, and if my friends haven't lost their jobs yet, then I'm not going to worry about anything in the future. I'm going to go out there and spend. And so, so that is what we continue to see here. We'll be looking at retail sales tomorrow. It looks to be, potentially up mildly so. But I saw a very interesting statistic recently, because we can worry if we'd like about the student loan payments coming due finally, starting in August, September. People who have loans, some research I've read just recently, who have loans out there, have bank account holdings about 40% higher than what they were in January of 2020. So they're really in better shape right now and can't afford to pay those loans. And their balances are equal to those who don't have a debt. So I don't know if maybe the concerns about a declining consumer are premature here.
Let's talk about where things stand specifically on inflation, because we have seen a broad pullback, but core inflation still very sticky. Consumer prices rose at the slowest pace since March 2021. We saw inflation slowing further, signs of cooling in June. We've got the Fed meeting next week. The expectation is that they will, in fact, raise rates. But the question is, what do they do after that meeting? What do you expect?
Right. And if you noticed, we as market watchers, pretty much consensus has said this will be the last one for a while now. And it's not been the last one. They started at zero, so they had to raise a lot really to get even restrictive here. They say that they're focused on the labor cost, and the labor costs are definitely not under control well enough yet. And they say they're very, very keen on getting a 2% inflation rate. I believe that Jerome Powell did a press conference where he said he said 2% maybe 14 times. He says it as if he means it. We should take him at his word. And so that being the case, the Fed is where any bull needs to wonder if the Fed is going to throw us into a recession, as it has mostly in prior tightening cycles. That's something to concern ourselves about, maybe late this year, maybe into early next year.
Linda, do you think we will see a recession?
We're calling for a mild recession at Federated Hermes because what we see today is a consumer that, as we said, is flush. We can see a recession that comes with a slowing economy by way of corporations, companies having problems, as we discussed earlier in our talk here, but a consumer that's really much stronger, much more resilient is the word that I keep reading, and I think that's true. And particularly when you consider that 80% or 75%, I should say, of the investable monies out there is held by people age 55 and older. That aging boomer group is really, really flush. Their balance sheets are in excellent shape, and they own their homes. You know, they're spending in a prudent way. So if we have to have a recession, we think that that the resilient consumer can make it mild, truly, and so far, that's looking good. And if I may say also, what's very unusual now is we look at the PMIs, we look at manufacturing and services, and we know that manufacturing has been in recession for a while now. The difference between services and manufacturing is stark, and that should close. And maybe it closes by manufacturing getting better.
Linda, let's talk about what's happening abroad. We did get the latest growth numbers out of China, coming in much weaker than expected. In the second quarter, we're talking about 0.8% growth. That led three banks today to cut their projections for China. We're talking about JP Morgan, Morgan Stanley, Citigroup. We're now looking at roughly a 5% annual growth rate. You say specifically there could be a potential tailwind coming from stimulus. I'm curious to see what you see specifically, because the expectation, at least among those who cover China, appears to be, yes, there could be stimulus, but not enough to keep the momentum going on growth.
Well, the momentum, I don't think that the momentum so much, and particularly in these last several months, has been for a very strong recovery in China. I think we've decided a few months ago that it won't be as strong as was expected, and then kind of the AI and the technology took the mantle of let's be bullish here on growth and on earnings in particular. But indeed, I'm not a particular expert on this. And in fact, any information I get about China crosses my desk can go both ways. The fact that the stimulus packages have been mild to what we would see seems to be more of a messaging that China wants to do. And definitely they have the wherewithal to do a stronger stimulus if they want, particularly concerned about the property sector there. So it may be milder than we expected, but we still may see some stimulus of a bigger impact coming down the road. And that could be yet another tailwind for global growth in the economy. And the energy patch, which I think you were talking about just before my segment here, that's had a tougher year this year. That's an area we think could have some value.
An area that we will watch. Linda Dissel, we have to leave it there. Federated Hermes, a senior equity strategist. Thanks.